The ultimate freedom is laziness investing. You can discover happiness through autopilot magic of ETFs and index funds. These are self-correcting, self-rebalancing. Watch full video as I share 3 powerhouse ETFs with the potential to multiply your wealth. The first is the ETF that tracks the healthcare index. The healthcare index has outperformed the broader Nifty 500 index by a margin of 1.2% per year for 15 years. That's 1.2% compounded for 15 years, so it's 18% more return compared to the broader market. It has also outperformed Nifty 50 by 2.2% every year for 15 years, which is 33% more compounded return. And the outperformance has come with very low correlation of 0.31. What this means is if the broader market goes down, the healthcare index may not follow that strongly. This is good for reducing the overall risk in your investment portfolio, as the performance of healthcare stocks may not be heavily tied to the broader market trends. It indicates diversification benefits. In 2008 and 2011, when the markets did badly in a declining market, the healthcare index declined lesser. In other words, it has outperformed the broader market. Healthcare indices outperform with a higher margin, low correlation, and downside protection. To me, a dream product is what outperforms the Nifty 50, outperforms with a low correlation, and that which will give a good downside protection when the market does poorly. When we look at the ETF under the Nifty healthcare indices, all these fund houses provide ETFs. As an example, ICICI Pru Nifty healthcare ETF has generated a return in line with the indices, less the expense ratio, which is about 0.15%, and the tracking error. The size of these funds are small, so one must look at the liquidity before investing. One may also consider active funds in this segment, as the healthcare index has 50% constituents in mid-cap and small-cap category. This category has more inefficiency and hence higher scope of generating an alpha, which is higher return compared to the benchmark. There are many sub-segments in this index and different kinds of companies like pharma, hospitals, diagnostics, CRO, CDMO. It's a heterogeneous sector where there is scope for bottom-up stock selection to create superior returns. The second is the ETF that tracks the banking and financial services index and the bank index. The BFSI is the fastest growing segment in India. For the last 20 years, it has beaten the Nifty 50 by 3% per year. Compounded for 20 years, so 70% more returns versus the Nifty 50. If you have done a monthly SIP in this index, you have beaten the broader market 97% of the time. Now comes the most interesting data. The financial services index has underperformed the broader market in the last 4 years. Markets run on emotion in the short run. The overhang of the merger of heavyweight private sector banks, succession planning in another big bank, outflow of FII during the last couple of years, fintech disruption worries were the primary reason. Many of these are behind us and market will find new reasons to mean reverse. For a long-term investor, long-term outperformance and short-term underperformance is a great combination, and a wise investor catches on to this opportunity. You can play this theme by investing in the ETF that tracks the Nifty Financial Services TRI. If you see the portfolio, this ETF not only has banks but also non-bank lenders and insurance companies. The other ETF is the Nippon India ETF Nifty Bank Bs. This is another ETF which mirrors the Nifty Bank Index, which has the largest weightage in the banking stocks. It's a very concentrated sector index with high concentration in the top 3 constituents. The expense ratio of this fund is very low, 0.19%. Fund size is very large, 6,500 crores, making it very liquid and easy to buy and sell. A word of caution to all these sectoral ETFs. This is suited only for long-term investors with high risk appetite and ability to take volatility. The index has a higher standard deviation than other large cap indices and higher downside. So mix this with value or low volatile strategy. Note that the large cap indices are also heavy on banking and financial sector. Hence, exposure needs to be tempered. The third one is the Nippon India Nifty India Consumption. Consumption sector is a long-term structural theme in developing economies like ours. Quant's research indicated start of a new consumption business cycle. There are multiple triggers why a consumption fund is likely to do well. The increasing millennials who are willing to spend for better experiences. Increasing women in workforce is leading to increased family income, which leads to higher discretionary spends. Growth in the mall culture leads to an increase in sale of foreign and retail brands. Growth in online marketplace has taken brand awareness to tier 3 and tier 4 cities, leading to increased sales and profits. These are the high frequency indicators of consumption. All these exhibit a very strong growth in business across passenger vehicles, bank loans, air traffic, credit card transaction. The Indian consumption theme is on an expansionary phase. But keep in mind, these ETFs are for high risk takers. It has low trading volumes, keep exposure limited. This mirrors the Nifty India Consumption Index. If you're looking at adding alpha or additional returns, you may also consider actively managed fund in this space. I have done a video on this. You can watch it here. There is also fifth ETF, but I'll put that in the description if there is sufficient interest through comments. If you like this content, please consider sharing it with your friends and liking this video. Do comment and subscribe to this channel.